Good afternoon. My name is Lionel Leventhal. First of all, I'm not pitching anything today, not marketing, not looking for any investments. This is a purely educational presentation. Really for the folks who are running family offices from two perspectives. Number one, in your capacity as investors in companies that are recurring revenue model companies, whether they're in the biotech, pharma, medical device, or other types of companies. And I'll be explaining what types of companies are a great fit for that. So number one, in your capacity where you might be shareholders in a company that's looking for financing for non-dilutive financing, whether it's to avoid a down round, whether it's to avoid dilution generally, whether it's to do something transformational because the amounts of capital that are available here and can be funded at low cost of capital can be pretty large relative to the existing valuation of the company. And number two, in your capacity as family offices where you might be private credit investors, I'm going to be explaining this form of financing as investment opportunities that would become available to you in the future. So I'm going to talk today about what is a royalty or revenue interest financing, and I'm going to contrast it with buying a perpetual royalty or a perpetual revenue interest, which is not what we're going to be talking about today. You can buy a perpetual royalty, provide X dollars and get 3% of sales, or a royalty that already exists. But what we're going to be talking today is a capped form of financing. And here, the difference between a royalty, and by the way, all these slides will be available to you after. You can feel free to take screenshots, etc. But all this information will be provided by Marty. But
There'll be a follow-up email with a link to this.
Basically, the difference between a royalty and a revenue interest is that a royalty already exists because of a license agreement. So think of a small biotech company that develops a product and they license it to Pfizer. Pfizer markets it. Pfizer pays the company that developed a royalty on every dollar of sales, 5% of sales, 8% of sales, whatever. Revenue interest is where a company is just basically marketing its own product. It's not receiving a royalty from anybody. A revenue interest is basically a temporary royalty that's created from the revenues of a company just to facilitate non-dilutive financing. And again, the way it differs from a royalty or revenue interest purchase is those might be perpetual and uncapped, therefore a very high cost of capital. This, you'll see for companies, is a very reasonable cost of capital. For commercial stage companies, the cost of capital is sort of low teens. The same cost as term debt, or perhaps 150 basis points higher, with some real benefits versus term debt. And that's what I'm going to be talking about. You can see a block diagram at the bottom, which just shows a revenue interest financing. A RIF, an investor provides capital, and in turn, they get a temporary percentage, again, of revenues of either one product or a basket of products, or all the revenues of the company, depending upon which. Doing this form of financing for a company does not delay money into the company. So basically, customers, when they're sending in invoice, when they're sending in revenues into the company for the purchase of the product, send their payments into the company to a lockbox. The investor gets whatever negotiated percentage, 3%, 5%, 8%, whatever. The company gets the rest. That's basically functionally how this works. Just for context, so I've been working focused basically 100% of my time on royalty financing for the last 25 years. I co-founded and was a general partner of Paul Capital Partners. Paul Capital Healthcare was the first royalty fund established in 1999, where we raised and deployed about $1.5 billion of royalty purchases and revenue interest financing, which today $1.5 billion actually doesn't even sound like a huge amount of money, but back then the total volume of royalty deals in the biotech and pharma industry for an entire year across all companies was like $50 million. So we kind of created this market. Interesting today, and at Paul Capital, we created this synthetic revenue interest financing. Today, in the healthcare market, there's approximately $3 billion of these financings done every year. So they basically, this form of financing has overtaken traditional term debt financing as a source of non-dilutive capital for both private and public companies that have market caps or valuations sort of under $5 billion. So if you're Bristol Myers Squibb, you don't necessarily need this form of financing. But if you're most companies below $5 billion use this form of financing all the time. Interestingly, there are approximately 35 to 40 funds who provide this form of financing in the healthcare market, each of whom can do $100 million financings on their own. There are really two categories. There's a traditional royalty fund. There are approximately 15 traditional royalty funds in the healthcare market. About 60% of them are managed by people that were either limited partners in my funds at Paul Capital, or were some of our junior employees at the time, or some of my partners. Then there's a second category of capital source, which I'll call a credit strategy fund or a special situation group. Those are traditional healthcare lenders, but they're not constrained by the box of having to lend in the form of 5-year term debt. So no company ever said, oh, I want to borrow 5-year term debt. That is literally the most brain dead form of financing that exists on the planet. It's useless to companies that are very young, not yet cash flow positive, because 5 years comes and goes in a minute. The reason the whole market is the term debt market is 5-year term debt is because a lot of the people that provide that capital have to do it in a very standardized way, so that after they lend that money, then they can take it off their balance sheet and syndicate it out or sell it to other banks. But no company that needs capital ever said, oh, I want to borrow money that's due in 5 years. So here, the fact that there are 35 to 40 funds that can each fund $100 million deals on their own, and many of them focus on deals that are really 50 million and greater, means that there's a large vacuum in the market for deals that are 25 to $50 million and below, which can be an excellent opportunity for family offices. Now, not every family office has a bite size of 10, 15, $25 million they can do alone, but we can put together groups of family offices that want to participate together. So although 90% of the work that I've done over the last 25 years has been in the healthcare market, this form of financing is very available for companies that are not in the healthcare market, that have recurring revenue models, whether they're SaaS companies, so software as a service. So any of you that use Microsoft Outlook on your computer, you pay a royalty every year to Microsoft. So SaaS companies are companies that are ideal to raise this form of financing. Franchise model companies. So, any of you who like Dunkin' Donuts, for example, those individual locations are not owned by Dunkin' Donuts, they're franchisees, and they pay a royalty into the parent, and franchisors can use the franchisee payments as royalties to finance large acquisitions of other companies. They can use it to, I was presenting to Harvest Partners, which is a big PE firm, and explaining to them how their portfolio company, Midas Mufflers, could use this to acquire mom and pop mom and pop muffler shops, pay a payment to the muffler shop owner, leave them as operators, convert them into a Midas muffler franchisee, and how they could use a facility of the revenues they have incoming from all their franchisees to build a facility so that they could buy and convert a much larger number of and make much more franchisees. Any company that's sort of subscription based or utility based, where there's a very sticky customer relationship, where the customers remain customers for years, are ideal for this form of financing. And then just generally licensors receiving royalties, whether it's music publishing, clothing, branded products, merchandise products can use for this form of financing. So this form of financing is totally appropriate for all these companies, not just for biotech and pharma companies. And again, you all might be investors in the companies that are recurring revenue model companies, and might have companies that need this capital. You might find it more attractive than term debt and traditional equity. So on the next page.
So is this apply towards, both therapeutics and devices
Yes.
equally?
Yeah.
Yeah.
So I would say, if you're looking at drugs typically have a much longer product life than a medical device. Medical devices, there's, when you have a therapeutic, you have the big barrier to entry of clinical and regulatory approval and intellectual property. You have orphan designation, you have intellectual property really protects the composition of matter. So therapeutics generally have a longer product life because they're much more protectable. A medical device, even if it's patented, really is protecting only one solution to a problem. So medical devices tend to have shorter product lives. This form of financing can be easily used by medical device companies, but just the structure might just take into consideration that the product life might not be 20 years, but might be shorter because of encroachments into the business by other products. So here I'm going to discuss this form of financing from the company perspective, the issuer perspective, a company that's looking to raise this form of capital. This form of capital can be available all at closing, or if a company likes to have the option of taking money now, and additional tranches of capital at key milestone payments can also be funded. A combination of amounts funded at closing and amounts funded on milestone and tranches. It's available in larger amounts than traditional term debt. So if you have the same company, the same asset that's looking at either term debt or this form of financing, this form of financing can provide a lot more capital than term debt. Why is that so? Term debt is typically sized based on either a multiple of existing EBITDA or what the company can reasonably expect to repay over a 5-year period until maturity date. This form of financing, which has no maturity date, and that's one of the advantages, the capital providers are not expecting to earn their return in 5 years, and so they might be expecting to earn their return over 7, 8, 9 years, and so they'll be willing to provide more capital than a term debt lender would provide. So first of all, this is available in larger amounts than term debt. It can be used to fund acquisitions, it can be used to fund product launches, it can be used to fund product development, and other growth capital needs. The investor, talking about the cost of capital, for companies that are medium size, large size, the cost of capital is comparable to term debt, maybe 10 to 13%. This might be 100, 150, 200 basis points more than term debt, but because larger amounts of capital can be raised relative to term debt, the return on equity to shareholders might be higher, even if this form of financing might be 100, 150 basis points higher, because you can raise a lot more of it, and therefore companies raise less equity when they're thinking about the mix of total capital that goes into the business.
Is the target a return of the capital plus, or is it target and IRR?
So some funds like to define, so basically these folks, the capital providers are getting a temporary royalty or participation revenue until they receive a negotiated cap return. Some of the funds like to negotiate that as a multiple invested capital. And in that case, for these sort of medium to large size companies, the cost of capital is sort of 1.45 to 1.75x. So that roughly translates into a coupon of 10 to 13%, if you think about it on an IRR basis. For smaller businesses, the effective cost of capital is typically starts at sort of a mid-teens IRR. Of course, the definition of small has changed over time, but yes.
Yeah, two quick questions. Do you collateralize the related IP?
Yes, and I'll explain actually how this compares to term debt, because typically term debt, the lender is taking a security interest on all current and future assets of the company. Here, a royalty financing transaction just takes a security interest on the specific product that's where there's a revenue participation, but that security interest does not block the company from all sorts of flexibility in terms of its operations. It doesn't block them from licensing out the product. It doesn't obstruct all sorts of, so even though there might be a security interest in the asset, that's just to protect them if there's a bankruptcy of the company.
What's the typical duration on something like this?
So again, there's no forced duration.
I know, but
Typically, again, the investors expect based on their own modeling, and you might not know what the capital provider's own projections are, but they structure it so that they expect to earn their negotiated cap return over 7, 8, 9 years.
So question, when we look at venture debt usually will not look at a transaction under 10 or $15 million just because of the due diligence they have to go through. What's a reasonable low end bite size for something like this?
Right, so I would say, I've worked on financings that are as small as 5 million, but I would say on the small end, sort of 10, 15, 20 million is more realistic.
Similar to venture debt.
Yeah. Although revenue interest financings are not a replacement for company formation equity capital, so the providers of this capital, if you've raised a few $100,000 for your company, don't expect the revenue interest financing provider to provide 10, 15, 20 million. Then they're looking to provide growth capital once the company has basically been financed in terms of its basic infrastructure. However, this form of financing is available for companies that are not necessarily EBITDA positive. So this form of financing can easily be accessed by companies that are not yet cash flow positive, as long as, and in fact, this financing is basically a bridge that helps take companies frequently to become cash flow positive. But the investors need to understand through a reasonable modeling of uptake that the company would become cash flow positive over the next 2 to 3 years.
I'm thinking companies that are rolling out to scale.
When you underwrite this, are there any special covenants that you underwrite to?
So interestingly, and that brings me to sort of the comparison between this and term debt. So term debt, again, has a 5 or 6 year maturity date. This form of financing does not have a maturity date. So the capital provider cannot send the company an invoice at some day and say, oh, I've gotten this much to date. now send me the rest, they have to sit there and patiently wait. Term debt typically has financial covenants. Oh, you have to have a minimum level of revenues by this date of X, or a minimum level of cash flow of this. There are typically not financial covenants in this form of financing. So this form of financing is effectively kind of like toothless debt, because it cannot push a company into bankruptcy.
You're basically a screen in a faucet.
Yeah. However, the investors do have a lot of protection. I'm going to talk a little from the investor perspective. The investors are actually, in some respects, better protected than a term debt lender in a bankruptcy. But this, which I'll talk about on the next page, but not yet. But this form of financing cannot push a company into bankruptcy. So number one, it's non-dilutive. Number two, there's an absence of maturity date, and typically an absence of financial covenants. Number three, as we discussed before, term debt has a security interest in all of the current future assets of the company. Revenue interest financing typically has a security interest that's narrower, that's just based on the specific product that there is a temporary royalty in.
Do you get a collateral assignment of the royalty stream?
Yeah, well, there's a UCC filing by the investor on the assets that relate to that product. Not just the IP, but the manufacturing facility, for example. And the reason they do that is if there ever is a bankruptcy of the company, that wouldn't be caused by this form of financing, but for other reasons, just like the business fails, they want to be protected against unsecured creditors of the company, so that they have a package that basically allows them to port that asset and all the assets that are required to make, manufacture, sell that asset out of the company into bankruptcy.
Do you get into creditor agreements as part of your financing?
It could be, although this form of financing does not really coexist well with other secured debt. So if a company has existing secured debt, this form of financing might come in, refinance that, and provide additional capital for the company. So typically, I'm not going to say it never coexists with existing senior debt, but it typically will take out existing venture debt or existing term debt, replace it, and provide a lot of additional net capital. And then the payments, this is actually treated for GAAP purposes as debt. So it does shield the company's taxable income from debt. So it's treated under OID accounting. So it is treated as debt. So it shares the benefit that term debt has, which is it shields taxable income. Lastly, on this page, this form of financing is really uncorrelated with the equity markets, and even largely uncorrelated with the debt market. So in an environment over the last 3.5 years where interest rates have gone up at 3, 4, 5%, this form of financing went up maybe 1%, 1.5%, 2%. Why is that the case? Most of the royalty funds, their cost of capital is defined by their PREF, by the preferred return they pay their investors, 6%, 8%. And they want to be seen as a long-term stable provider of capital. So they're not like ratcheting up and down their interest rate based on how interest rates in the market, they're pretty stable. I think a good example of how uncorrelated this is with the equity markets, there's a company that we helped sell a royalty. This is a biotech pharma company. Their main product got a CRL, which is turned down from the FDA. They had this royalty from a small product that they had out-licensed to a European pharma company. The company was doing very poorly. We basically sold a royalty at 140% of the company's market cap. So you would think, oh my God, a company that's in distress, how do they have enough negotiating leverage that they can sell an asset at a high price? Basically because these royalty payments are passive and received from a marketer, the financial condition of the company itself is not really relevant. we were able to sell this royalty at 140% of the company's market cap, which demonstrates that, again, it's not correlated with how the equity markets might be valuing this company.
We have about 10 minutes,
Yeah.
but but if you need to restructure these, I mean, you were talking about selling one that was underwater for 140% of the value of the company, but
Yeah, we sold a
What other-
royalty interest. So basically, from the company perspective, there's a negotiated cap return. Companies can refinance these out. We typically try to negotiate a discount so that if the company wants to refinance it out within 2 years, 3 years, or 5 years, we typically we'll negotiate a discount to the cap return. From the investor's perspective, the investors are funds, and their returns, the way they like to think of their returns, are multiples of capital. And if they are able to exit within 2 or 3 years, they're amenable to a lower cap. From the family office perspective, so for you all as thinking about it as investors, if you'd ever like to invest in this form of financing, you can either, in some cases, purchase a perpetual participation in royalties or revenue interests or revenues, or a negotiated cap return. So I mentioned that for medium to large size companies, the cost of capital is sort of a 1.45 to 1.75 multiple, like 33% IRR. For investments in smaller companies, and smaller companies can still be very financially stable and still have huge opportunities. So we're not talking about fragile companies, we're just talking about smaller companies. The cost of capital, meaning what a family office can earn on one of these investments, can start in the high teens, like a 2x, or it can be 3x or 4x. So you can really earn equity returns with having like a debt-like risk exposure. One of the things I think that's relevant is for any of you that have invested as in the private credit market, there's a company that goes into bankruptcy. On the day the company goes into bankruptcy, term debt lender, any interest they earn after the day the company files for bankruptcy is treated as post-petition interest. So the senior lender has to fight with unsecured creditors to get any interest payments after the date the company files. For this form of financing, so for example, if there's a negotiated cap of 1.75x, and let's say your family office is an investor, there is basically a self-executing put option that puts the revenue interest to the company prior to it going to bankruptcy. So your entire return of 1.75x is protected, and none of it's treated as post-petition interest. So you're basically actually in a better position than the term debt lender in terms of bankruptcy. And this form of financing has been well tested in bankruptcy and sailed through bankruptcies, protecting the revenue interest finance investor. Again, I'd like to highlight that this financing, almost by design, can't cause a bankruptcy, but companies go into bankruptcy because their operating model fails for many other reasons.
are these agreements ever underwritten with warrants granted as well?
It's pretty unusual. I mean, it's really non-dilutive financing. For really small companies, anything's possible. I mean, there's nothing that says you can't, but I think one of the attractive things for example, companies that family offices are investors in, and if you want to raise non-dilutive financing, you'd really like it to be non-dilutive. So I mean, that's what we focus on. So for family offices, again, as investors, lots of opportunities, not just in pharma and biotech and medical devices, but across all sorts of companies, lots of opportunities in the $10 to $50 million for total transaction size. And again, depending upon the bite-sized investment for the family office, we can pool together a bunch of family offices, for example, to structure smaller transactions. So you just run through, I'm not gonna really run through in much detail, but you will have access to all these slides on the next page. This is just a summary of, transactions that I've done over the last 25 years, mostly in the healthcare industry. The next page, the total time. So the total time to get a financing done from the date we start working with the company is 3.5 to 4 months. So this isn't done overnight. The investors here, when it's in the healthcare market, will do more diligence than anyone who's ever bought a share of stock in a public company. So they're big, taking revenue interest financing from one of the existing healthcare funds is huge validation of the company. Even though they're earning a capped debt return, it's a huge validation. And next page.
And
Yeah.
what's the likelihood of getting financing once you started through stage one of that?
So basically, the first, just go back to that
Yeah.
page so that people could see. So the first phase is just our putting together a confidential information memo. The second stage, we basically provide confidential information memo and a model in a data room. By the end of that month, we're already getting back markups to term sheets. So basically, within 2 months of our getting started, companies are gonna already know how robust the interest is, and we'll be getting markups to term sheets. Then in the third month, the investors are rarely spending money on due diligence until they know that a term sheet that they've provided is close to what a company wants. So the third month, they're basically the funds are spending their money doing confirmatory diligence, and in parallel marking up a draft of a definitive agreement that we would help prepare with the company's lawyers. And then the last 2, 3, 4 weeks, once you've selected a finalist, once you've narrowed it down, just finalizing the definitive agreement.
So it's slow for debt financing, but maybe it's satisfactory
It's
for today's
actually,
environment.
yeah, it's actually not that slow relative to.
It's on par with
debt
that
financing.
finance.
Yeah,
Do you think so? Okay.
yeah, it's pretty similar.
What do you charge?
So it depends on the size of the transaction, but for transactions that are 100 to 300 or 400 million, we typically charge between 2 and 3.5%. So it's much less expensive than raising equity. It's sort of on par with the cost of, I guess, raising convertible debt. Yeah.
How transparent are the investors of the fund to the company seeking investment?
So on the diligence upfront, not really. Typically there might be somebody who's nominated to
I'm
be
thinking
like,
more along the lines of foreign actors with all of the
oh,
focus
yeah,
on international money right now.
oh, trust me. I mean, we follow strict AML. We would be doing KYC diligence. We're FINRA regulated.
Well, I mean, Chinese money was okay 5 years ago. It's not
Yeah,
okay for our
yeah.
industry.
I mean, literally, the company, and all along the process, the company knows and has the opportunity to
That's the
say,
question.
no, we don't want to talk to these people. We don't, this isn't something where just like 3 or 4 months later,
Mhm.
definitive agreements show up to be signed. This is something where the company.
So there is transparency along.
Complete every step along the way, every step along. the way.
You talked about working with franchisors on this.
Yeah.
So would you work with both the franchisor and a franchisee?
It
Or
could-
like
it
a
could be-
group, like a super group of franchisees?
So for example, I'm talking to a franchisee of Buffalo Wild Wings in Southern California who wants to buy an adjacent region of franchisees. So, yeah. it could
That's
be-
right, so
it could
it's the
be
example I was
easily
thinking of,
used-
yeah.
It could be easily used by franchisees as well, who are excellent operators.
Yeah.
How do you assure compliance?
And you say like.
Well, compliance in terms of making sure that you capture all the royalties that are due. And
Ah,
there's
okay.
no side, like,
good, very good question. So for example, we would basically convert, all the customers are required to send their invoices to a lockbox, which is a segregated bank account. That might be at the bank that the company uses already, but there'd be a letter of a agreed upon form that's sent out to all customers, and the company is required to have all customers send their payments for invoices for product they purchases or wholesalers into that. And there occasionally could be like a misdirected payment where someone just in error sends something directly to the company, and there's documentation that covers the company. So, you know, there are bad people out there, so I'm sure there might be companies that, but that's not generally the type of company that you would provide capital to anyhow. So
You basically set up like it's a factor.
yes, the difference is factoring, you're factoring a set of receivables. This is like an ongoing. So this slide, which you'll get.
The factor would also be time box, no?
Right.
Yeah.
This is like, so this slide compares royalty financing with term debt, convertible debt, other, along the dimensions I've already described. Again, all this will be provided to convert to the next page. That's my, just a little bio. Next page. So senior most junior person on my team, last. Okay, so this is my contact information. Again, you have access to all this material, but look forward to, again, in your capacity as being shareholders in a company that might be looking for non-dilutive financing, or if you're interested in providing this form of capital, we can introduce you to a lot of opportunities that we'll.
Yep. Fantastic, Lionel, looks great, thanks so much.
Thank you.